Have you ever heard of seller financing? Seller financing is an option that a lot of people are taking nowadays when they're looking to purchase new property. And there's many reasons why a person would go with seller financing versus going with regular bank financing. And I'm going to explain all of those things to you in this video. Right now, the market is very tight and the banks are tight with their money. So a lot of people are not able to get regular mortgages. At that stage, if a person really wanted to buy a home and they're declined by the banks and they're declined by B lenders and private lenders, and those other options are not available to them for one reason or another, seller financing is an option that is still available. So what is seller financing? Well, seller financing basically is where the seller of a property holds the loan for the buyer. So what ends up happening is a buyer will walk into a property, they will make usually a significant deposit onto the property, and then the seller will finance the property for the potential buyer. Normally, it would be at a higher interest rate than what they are getting for their regular financing. Actually, what the sellers are getting for their financing, so that the sellers are profiting off of the transaction. So there is no traditional lender. The seller is the one that holds the loan. And there are usually flexible terms and conditions that are negotiated between the seller and the buyer. So the bank has nothing to do with this. It's all between the buyer and the seller. So, how does seller financing work? Well, essentially, what ends up happening is just like a regular property purchase, a person would walk into a property and they would be offered seller financing by the seller of the property. Normally, you wouldn't walk in and say, "Hey, would you be willing to do seller financing?" after you've fallen in love with the property. You only want to be entering properties that are willing to do seller financing. So, that would advertise that seller financing is available. Now, what ends up happening is, let's say you want that property. You walk into the property, you say, okay, I want to make an offer in on this property. The sellers will have what their price is, and they will also explain to you what the terms and conditions of the seller financing that they are willing to do. Now, a lot of times a person wouldn't let you do 5% down with seller financing. Normally, what they would want is 20% or more, because they want to have some equity in that property so that they can pull the property from you if the market crashes or if the market goes up or whatever that might be. So basically, you negotiate your terms and conditions with the seller of the property. It's all legal. They can't just take the property away from you. The everything is in the terms and condition. This is all gone over with a lawyer. So you're going to agree on purchase price first. So let's say a property is listed at 340,000. If they're doing seller financing, they may ask for 350,000 for the property, for all I know. A lot of times when you do seller financing, they are going to charge you a little bit of a premium because they want to be making money off of it, not just off of the interest rate and the monthly payment, but maybe also on the principal amount of what you're paying for the house. Next, you're going to negotiate on what the down payment is going to be. Now, obviously, a lot of buyers out there are going to want to put the minimum down. That's the most common type of situation. In a case of seller financing, they're going to want usually a significant chunk of change down. That's their security. So obviously, your credit is not going to be their security because there's a reason you're going to seller financing. Your job situation may not be the security, but money will be the security, and equity in the home will be the security, definitely. So if you're putting a larger down payment down, a seller is more likely to offer seller financing to you. And then finally, the loan term is going to be another thing that they negotiate on. So you're talking about the interest rate, and normally the interest rate is going to be a little bit higher than a regular standard bank rate. The people are going to want to make money off of this normally. Next, the monthly payment is going to also be something that you negotiate on. Sometimes people will want to build in a little bit more equity into that monthly payment, and so the sellers are up the what the monthly payment is going to be, so that they get a little bit more cash in hand. And finally, the length term of the loan. So Normally a person that's doing seller financing is not going to want to do a 25-year term for you, just like a bank with or our bank would, or a 30-year term or a 40-year term. It just wouldn't make sense. They don't want to be in that investment forever. They want to cover you for a short-term situation and then allow you to go to a regular bank and get your financing so that they can kind of cash out of that property, unless you're paying them a huge interest rate and they're just absolutely benefiting from it. But it has to make sense for both you and for the seller of the property on whether seller financing is good or not. And there are some absolute risks to seller financing. So keep on watching the video and I'll explain some of these things to you. So, what are the benefits of seller financing to the buyer? Well, first of all, it is easier to qualify. That's the biggest benefit. If you could walk into your bank and get an approval right now, you can go and buy any property. You don't need seller financing. With a seller financing situation, it is easier to get approved for that mortgage. Next, there's fewer fees. There's no fees involved in seller financing. There's no real estate commissions payable. There's no additional fees. You still are going to have to pay legal fees if you're smart. You're definitely going to want to deal with a lawyer, but there are less fees involved in seller financing. There's flexible terms. So that is dependent on the seller. Some people may have very strict terms. Who knows? They can essentially do whatever the heck they want if they're the seller and you're the buyer and you want it, and this is the only way you're going to get financing on that property. And of course, a faster closing process. You don't have to wait for banks to do paperwork and this and that. If you want to close this transaction in 5 days and move into the house, then yes, you can do that. So, what are the benefits for the seller? Why the hell would these people do it? I mean, in most cases, it wouldn't make sense, but in some, it definitely would make sense. So, first of all, they get rid of their property. Okay, so if this property is a hassle for them and they just want to get out of it, then they might do seller financing. Second of all, is they could play around with the price. They might up the price if they're offering seller financing to you. Like I said, if a house is listed for 340,000, they may sell it for 350 or 360,000 to you. Appraisals are not involved in seller financing. So even if the house doesn't appraise for the amount that you're paying for it when you're the buyer of a seller financing transaction, it doesn't matter. The bank can't say no, you're declined, because the sellers are the ones that are making all of the decisions. So they can up the actual principal price of the house if they're doing seller financing. The other thing that they are most likely going to up is the interest rate. So let's say that their bank rate is 2% on this house and they want to make a guaranteed return of 6 or 7%. Then they might up that interest rate to 9% for you. So just be aware of that your interest rate is probably going to be higher. The amount you pay for the house is most likely going to be higher as well. And finally, they do have like a significant amount of security because they still own the house. The house is in their name. You mess up on payments and you're the buyer in this situation, they could foreclose on you and keep all of that money that you've paid into it. So that could be keeping all the monthly payments, that could be keeping your large deposit, and they are going to want a large deposit for you to do this, but they'll be able to foreclose on you. And then they can also go back and sue you for not completing the transaction. So make sure you read the terms and conditions and get a good lawyer that's going to cover your ass if anything comes up. So what are the risks? Well, I just kind of went through them for you. Higher interest rates, higher price. These are all risks to the buyer and a risk of them foreclosing on you and taking the property back. If you don't make your payments or you're not taking good care of the property, then there will probably be some terms and conditions in the contract where they can foreclose on you and kick you out of that property. But there are risks to the sellers as well, or else everybody would be doing this. I mean, this could be a potential cash cow for somebody. There are big risks. What if the market takes a dip and then the buyers are like, we don't want this property anymore? So they could walk away from the property if the market takes a dip. And let's say the property value when they bought it off of you was 200,000. Market takes a huge dip, 50 per, 100% dip, let's say, and the market value of the property is only 100,000. These people don't want to pay into the thing anymore. They're not stuck like with a bank and have this thing on their credit bureau. It's not on their credit bureau. It's not reporting. So there's no risk to them for saying, oh, Here you go. Take your keys and walk away. They're going to lose too much money if the market takes that kind of dip. Next would be obviously the cost of foreclosure. So if you do have to foreclose on this property for any reason, then you will probably lose some money on it. There are costs involved in foreclosing on a property. So you want to make sure if you are in a seller financing situation and you're the seller, that you vet these people well. You make sure that they're going to pay their bills, that they're putting a huge deposit down, all of these things to make sure that they're not going to not pay you. And of course, the risk of the buyer defaulting, not making the payments. If they don't make the payments, obviously you have to foreclose on them. Foreclosure costs money. Them not making payments costs money. All of these things. So if you are in that situation and you're going to do seller financing for somebody, then you need to take that into consideration and make sure you're saving some money in a bank account separately so that you can cover those costs should they come up. Now, that being said, if people are putting a huge deposit down, they're paying the high interest rate, they've got some equity built into the property, then it is much less likely that they're going to end up foreclosing on the property or not making their payments. But you don't want to have to chase people. So make sure you put in your terms and conditions that you can foreclose on them if a certain number of payments are not made within a certain time frame. So can you buy a home if you have bad credit using seller financing? Yeah, you can. Absolutely. That would be one of the main reasons why you would buy a home through seller financing is if you have bad credit, then you can qualify with seller financing. Another reason a person might qualify with seller financing is if they have too many properties. If they have a whole bunch of properties and they can't qualify for another mortgage, then seller financing may be an option a person wants to use if they want to build equity in properties. What happens if the buyer defaults? Boom, they get foreclosed on. They're out of there. So make sure if you are the seller, you put it in the terms and conditions that you can foreclose on the property. If you are the buyer, make sure you make those payments because you don't want that seller to be able to foreclose on you. You don't want anyone having any more power over you at all. Do the buyers get title right away? No. The buyers will not get title right away. They will be on title, but the main owner of the property is the main owner of the property, and they have to stay as the owner of the property until the time where the buyer takes over that property, where they can put it under their name, qualify on their own with their own bank, or pay off the property, whatever comes first. But the seller has to stay on title. The buyer can be on title as a lien holder on the property, but they're not an owner until they take over the full ownership of the property by financing it themselves or paying it off. Can the seller still have a mortgage? Of course, the seller absolutely can still have a mortgage. They will most likely have a mortgage at a lower rate than what they're charging the buyer. So keep that in mind. Normally, what I've seen in these seller financing type situations, they only usually want to finance the property until the end of their mortgage term or 2 years. One of those two things are normally what comes up. And then the buyer has to get their shit together and get the financing on their own after the 2 years or after the term is complete. If they're not capable of doing that, then the sellers can foreclose on them. And that's usually right in the terms and conditions. So if you're a buyer, make sure you're aware of that. You're going to have a time frame where you have to get this out of your name. I've seen so many situations where people have bought these seller financing houses, not fixed up their credit or whatever that might be, and all of a sudden the sellers are foreclosing on them and they don't give them any of their money back. That's what ends up happening. And I guess that's one of the benefits to sellers is they can just foreclose on you if you don't make your payments or if you breach the contract. And a breach of contract would be not being able to take over the financing in the time frame you need it taken over or the sellers want it taken over in. So is seller financing right for you? I don't know. I don't know the answer, but I hope I was able to give you like all of the risks involved in seller financing. Please make sure you get a lawyer if you're going to be doing seller financing. And I would talk to a real estate agent. Maybe call me if you have any questions about that. My number is going to be in the comments below because I've seen all sorts of situations. I've seen sellers take the houses away. I've seen buyers throw their hands up and not make the payments. I've seen this work out really well for some people, and I know some investors that buy through seller financing often. Guys, if you like the video, please like and subscribe to the channel. It helps me get this information to the people out that need to see the video. Uh, Call me if you do have any questions about seller financing. I'm a mortgage broker, so if you do need or do want to get a mortgage, I am the easiest way to get approved for a mortgage in Canada. Thanks for watching.